Welcome back, Ryan Miller Trading Economics. Have US Treasury yields finally peaked? Maybe. That's the short answer. They very well might have. However, there are still significant risks to the upside in yields, downside in bond prices. Okay, so I'm very weary whether this is the top in yields or not, because yields have been falling because the market is pricing in a Fed pivot, not a recession. Okay, those are the risks. All right, the market's pricing in a pivot and not recession. Okay, so let's take a look at why, at what's going on here. So why is the market pricing in a Fed pivot? Well, last week we had an inflation reading that missed expectations, came in lower than the market was expecting. Right, the headline CPI fell from 8.2 down to 7.7. Right, core CPI fell from 6.6 to 6.3. Right, so the market mainly looked at this headline, right, down from 8.2 to 7.7 year over year. Right, it's 0.5 percentage point down, and the market celebrated. They said that's it, inflation's coming down. The Fed doesn't need to be hawkish anymore. Come December, that's going to be the last rate hike. They're going to pause. They're going to talk about cutting rates a lot earlier than expected, right? And that's why yields have been coming down, right? And we know that because if we look at Eurodollar futures curve, right? Let's make that smaller. Eurodollar futures curve prices in future expectations of the federal funds rate. Now, this orange line was the day prior to the close of the day prior to the FOMC meeting on November 2nd. Okay, this is where the market was pricing in a peak of Fed funds around 5.25. Okay, now as of yesterday, the expectations of the Fed funds have come down quite significantly the further out we go. So this goes from December 2022 to December 2024. Right, so the entire Eurodollar futures curve has shifted lower, right? Meaning the market expects the peak in the Fed funds rate to be lower, and the Fed to start cutting rates earlier and faster than expected, right? So the expectations of federal funds rate has shifted lower, right? And you can see that in the curve here. The entire curve is shifted lower, right? And when the expectations of the federal funds shifts, the Treasury curve shifts with it. Okay, so if we were to look at the Treasury curve, right, nominal yields shift with the expectations of the Fed funds. So this was the Fed meeting, the very hawkish meeting, one of the most hawkish meetings Powell has ever had, if not the most hawkish, and yields started to push higher, right, because the curve shifted higher. The expectations of the Fed funds pushed up, so nominal yields started pushing higher. And then the CPI miss happens, right? CPI comes in lower than expectations, and then boom, yields drop sharply, right? Because the market's thinking, okay, that's it. Fed's going to pause, right? Pivot's going to come soon. Yields fall, right? We could price in lower yields now, and now we can buy risk, right? And that's why we've seen equities rising, right? The market is front running a potential cut or a pivot in by the Fed. And then they think that means a bottom in the economy, avoiding recession. So they're trying to front run that by buying risk, right? Buying stocks. Okay, so that's how we know the market is expecting a lower Fed funds rate, right? And this caused yields to fall, right? The curve has shifted lower because Fed funds expectations have shifted lower. Okay, now we're going to come back to this, but how do we know the market is not pricing in recession? So if we look at credit spreads, which measures risk in the credit market, you would normally see this trending up, and it has been, right? But very, very choppy, right? Grinding at best, right? More recently, credit spreads have been tightening. FOMC meeting was right about here. Since then, credit spreads have actually fallen, have actually compressed, gotten tighter. The credit market's pricing in less risk today than it was just a couple of weeks ago. right? Not pricing a recession. If this was pricing in recession, we'd see it marching its way towards 300 basis points. But right now, it was slightly over 200. It's now fallen below 200 basis points, right? If we look at the S&P 500 to TLT, long duration bonds, this is a representation of nominal growth expectations, still quite elevated, right? Been choppy recently, but elevated, right? So nominal growth expectations are still elevated. If we look at IWM to TLT, which is small cap stocks, coming down a bit more. This represents more cyclical growth, so it's coming down a bit more, but still elevated, right? If we're expecting recession, we would see IWM underperforming TLT a lot more than we are right now, because as you can see, it's been trending up, right? And still elevated. If we look at VCLT to TLT, which is corporate bond ETF to long duration risk-free ETF, not only is it elevated, it's been rising. FOMC meeting was right here, right there. Since the FOMC meeting, corporate credit has risen against long duration bonds, right? Pricing in less risk, right? Less credit risk, right? That's not recessionary. That's not market pricing in a recession. Okay. Now, despite the equity market pricing in a Fed pivot and front running a potential bottom in the economy, the bond market is saying something different. So this is FOMC meeting November 2nd. The 2 and the 10-year spread, the yield curve, 2 and the 10s, was about 50 basis points. Since it is flattened or inverted deeper to 66 basis points, right? The inversion went from 50 basis points to now 66 and has fallen sharply since the beat in the, or the miss rather, in the CPI reading. So as the market has celebrated a drop in CPI from 8.2 to 7.7, the bond market has gotten more inverted, right? That is very recessionary. Okay. So market right now, pricing in a Fed pivot, not pricing in recession, right? That's a risk. Now, what is the risk going into from a nominal yield perspective? What is the risk going into the December Fed meeting? So the risk is that Powell, in his press conference, is more hawkish than the market expects, which is very likely considering the market expects the Fed to talk about pausing and pivoting in the future, right? And starting to cut rates. So if if Powell is just as hawkish in his last meeting as he's going to be in potentially in December, right? He could shift this curve higher again, meaning he can shift the expectations of the federal funds rate higher, can shift the peak higher, can shift the curve as we go out in the future higher, meaning, as Powell said, higher for longer, right? So if he's able to shift this curve higher, again, expectations of the Fed funds higher, well, the nominal the Treasury curve, nominal yields are going to shift higher with it, right? So we're going to see nominal yields. If he can shift higher the Fed funds expectations, they are going to shift higher with it. Now, can he shift it high enough to get it back above this high? Right? Maybe. It's definitely possible. Right? Depends how hawkish he is. Right? So we're gonna have to wait and see. So this may be the peak, right? He might not be able to push the expectations high enough for nominal yields to rise above this peak again. Right? He may not be able to, but he may also be able to, right? Given how hawkish he was last meeting, and not much has changed, right? What is the reason he would continue to be very hawkish to push this curve higher again, right? To shift the expectations of Fed funds higher, which would then shift the nominal curve higher. Well, if we look at core and headline CPI, core has been stuck above 6 basically the entire year. Headline CPI, yes, it's coming down, went from 8.2 to 7.7, but we're nowhere near the 2% target. Nowhere near the 2% target. And somehow the market is celebrating 7.7% headline CPI. Again, core is still stuck above 6, nowhere near the 2% target. So what is there to celebrate? What would give Powell a reason to pivot, right? Much too soon. If we look at, and so remember, Fed has dual mandate, right? Price stability and employment. If we look at employment, unemployment is still near historical lows, 3.7. That's not going to get the Fed to pivot, right? If we look at jobless claims, we're around 200,000, which is pretty low. We're around 200,000. If we go back to 07, 08, right? Prior to the recession, we were up over 300 and then accelerated into the recession, right? We were above 300,000 job losses a month. Same with 2000. Prior to the recession, and then going into it, it accelerated, but we were over 300. So initial claims prior to the recession that we're about to get into is still very low, right? If we look at wage inflation, it's peaked, it's coming down, but very elevated to the long-term average, right? We're very elevated. So the Fed's going to look at these things. Look at the CPI. They're going to look at unemployment rate, jobless claims. They're going to look at wages, and they're going to say labor market's very tight, right? We have to keep going, right? That's the risk here. That the Fed's going to use these headline numbers, right, and shift this curve higher, which is going to shift nominal yields higher, right? That is the risk. And that is why I'm saying it is too early to say, hey, this is the peak in yields. It could be, but I think it's too risky to, place a big bet on this being the bottom in bonds, the top in yields, right? So that's what I'm seeing right now. Those are the risks I'm seeing. We're gonna have to see how this plays out. All right. I hope it made sense. If you have any questions, let me know. If you enjoyed it, please like it, share it, subscribe, and I'll catch you in the next one.